All right, good afternoon, team. Welcome back to Walks on Wall Street. It is Tuesday, September 6th, 2022, and welcome back, as I like to say, the official, first traditional day of the real world, right? Everybody's back in the offices, mostly. We covered last week on the stream that pretty much the drop dead date for everybody to return to the office, at least, not only full-time, but on a hybrid work schedule, was the day after Labor Day. So hopefully everybody got a nice chance to sit back, relax, sort of unwind, and hopefully you all had a fantastic first day back after the long weekend. Now, we know that usually after Labor Day, all of the main hedge fund managers, the bigwigs on Wall Street, are now back from their summer hiatus in the Hamptons, in Connecticut, parts of Rhode Island, and pretty much back in the office. And we saw that today. We saw Bill Ackman do an interview today on CNBC, which I thought was a rather nice interview. I agreed with many of the points Bill Ackman said in relation to the Federal Reserve's trajectory on monetary policy. How long will they raise interest rates, or I should say how much will they raise interest rates, and how long will they keep them there? So we'll go into Bill Ackman's interview on CNBC. We'll also talk about the broader general markets. Now, the markets got absolutely hammered today. And I know we're going to talk about the stock market. The S&P 500 was down about 16 points. The NASDAQ and the Dow Jones Industrial Average down as well across the board. But I think more importantly that I want to draw everybody's attention to is the instability that I'm seeing in the debt market. Okay, so we're seeing extreme moves in that 10-year U.S. Treasury yield. We're seeing extreme moves in that 2-year Treasury yield that I'm not liking. Okay. So that 10-year Treasury yield, I believe as of today, closed at about 3.342%. That 2-year U.S. Treasury yield is now 3.509%. And we're going to finish the stream off by talking about the housing market, because as of today, obviously September 6th, a 30-year fixed rate mortgage is now 6%. Okay, that's almost 100% higher than it was this time last year. We're going to talk about what that means for the housing market. Do we see a crash? Do we see a little bit of a slowdown? What does it mean? We'll talk about it tonight on Walks on Wall Street. Let me put away my computer here, everybody, and we will start the stream. Just bear with us here. It was raining all day. It was a crazy, crazy day. Rain, wind, mist, you name it, we had it. But it's one of my favorite people, David Goggins. I believe that's his name, David Goggins. He's like, not do the stream. You can hear me. I have been having some audio issues with the microphone, so just let me know if you guys could hear me in the chat. Maybe a little bit muffled. I think you guys can hear me, right? Some of you are saying you lost some audio. What about now? I think it's because it's been raining so much. My audio ports have been a little bit... okay, you lost me for about 20 seconds. All right, well, we'll do the intro later. I think the most important thing, everybody, is we say hello to everybody in the chat. I see Jay is here. Welcome, Jay. Good to see you. I see Zach Drew, Sunshine After Rain. Bernard Friedman is here. Welcome, Bernard. I see Austin City Limits. I see Savi. This is a very good evening, Tom and everybody. Welcome, Savi. Happy Tuesday. Hopefully everybody had a good Memorial Day. I see GX72. This is hello, Tom. Myra King says good evening. Welcome, welcome. Yeah, you know what I think it is? I was in between meetings today, and it was absolutely teeming raining out, like pouring raining. The wind was whipping sideways. So I think there may have been some water in my lightning charging port, so maybe that's causing a little bit of connection issues, but hopefully it'll sort itself out. And we also may go through a little bit of buffering issues as well, because usually whenever there's a big rainstorm or something like that, we have some issues with the internet connection, but we'll work through it. We'll get it done. I see Jay is here. Good to see you. M and Julia, one and only War Walker from the 305. Good to see you, War Walker. Wendy England, good to see you. Donald says, we seem low on the ground, Tom. Yeah, maybe we'll see some rats in the video. Good to see you. Mike Skate TV, welcome everybody. Vinny Castellano, the one and only, good to see you. Vinny is joining us from the one and only Staten Island. Welcome, Vinny. Hopefully you and Maria have had a good Labor Day weekend. So we're starting off the stream near Madison Square Park. We're gonna be walking a little bit downtown, but then we will be heading uptown near 34th Street, Pennsylvania Station. Now, obviously we've been talking about how there's probably going to be a very noticeable uptick in volume across the major exchanges now that essentially summer, the official business terminology of summer, is behind us. Everybody's back in the office. So I think we're going to see a big pickup in volume on the exchanges, so expect increased volatility there. But aside from the stock market, what has worried me today is the huge gyrations we've been seeing in the debt market. Now, oftentimes on the stream, I'll always make a point and make a note that if we want to know where the stock market is going to go, it's very important to keep our eyes fixated or peeled on the debt market, right? Because at the end of the day, the stock market literally derives its value, or is a derivative of the debt market. And as we move into the era of quantitative tightening, we know that the Fed is not going to pivot. I think that is telling the market that rates are going to go one way, and that's higher. So we've essentially broken out pretty strongly over the 2011 highs on that 10-year US Treasury yield. And it looks like we're gunning for 2007 levels, where we were on that 10-year US Treasury. And if you guys notice, you know, throughout the day, if you pull up a chart of the S&P 500 or the NASDAQ, wow, check out the view of the Empire State Building tonight, everybody. That is a cool blue color on the Empire. Looks amazing. So if you have tradingview.com, right? So if you go to tradingview.com, it is a free, 100% free charting software. I would encourage everybody to utilize it. Get familiar with it. If you pull up the SPX or the broader S&P 500 indice, and then you slap a chart of the 10-year US Treasury yield right over that, you'll see a very noticeable correlation there. And as of now, you know, actually let's cross the street so you guys can have an even better view of the Empire. But as of now, what we're seeing is anytime that 10-year US Treasury yield gets a bid or a Treasury yield up, stocks are down. It's almost like an occurrence every single day. And it's not a big deal if that 10-year US Treasury yield is up. It's the pace at which it goes up. And we've been seeing some pretty heavy selling in the debt market, which to me leads that there's some instability in that debt market. So look at across the board in the yield curve. Look at the 10s and 2s. Look at that 30-year US Treasury. You know, the yield curve is pretty inverted. And I think that's saying a lot about the broader based US economy. Now, I think the PMIs, or the Institute for Supply Management Purchasing Managers Index, or the PMIs, the manufacturing numbers, have pretty much predicted this, right? We've been talking about this almost ad nauseum. As those PMIs roll over, so has the S&P. Hey, Stephen, Gary is here. Says, great view, Tom. Good evening. Thank you so much. Yeah, this is a fantastic view. Right now, we are standing on the corner of 5th Avenue and East 23rd Street, overlooking the beautiful Empire State Building. lit up in a very cool blue with beautiful looking clouds amongst the top of the Empire. February says, how's it going, Tom? Austin City Limits is like, yeah, the 10-year US Treasury yields. Yeah, so Austin City Limits, what do you make of this, crazy action in the bond market here? So the US 10-year Treasury yield, I believe, closed at about 3.342%. And that 2-year US Treasury yield is 3.509%, obviously inverted there. Now, what I'm a little bit concerned about, everybody, is the print we had today. Usually I'll look between, the debt market and the stock market, see the correlation there, but check out that 30-year fixed rate mortgage. As of today, the yield on a 30-year fixed rate mortgage is over 6%. That's pretty significant. And I think from here, in my opinion, I think there's only one way for yields to go, which is higher. Okay, and usually that 30-year fixed rate mortgage follows the trajectory pretty much in lockstep with that US 10-year Treasury yield. And we had a huge move to the upside. So I think that's going to put some pressure on housing. I think that's going to put some additional pressure on housing. I mean, if you think about the people who were buying homes this time last year. Hold on, let me turn around one more time for you guys so you can see the beauty of the Empire. There's actually a lot of people on the street tonight coming out to take a picture of the Empire State Building just because it looks so beautiful. I think this may be one of my favorite color schemes tonight. Obviously, you guys know my favorite color scheme is the classic red, white, and blue, which we had the pleasure of seeing yesterday for Labor Day. But if you think about people who bought homes last year, you guys were locking in rates at 3%, right? So you've essentially doubled the cost of capital. So what is that going to mean for the family that was looking at, in their budget to purchase a $400,000 home, right? Let's say if the home you wanted to purchase $400,000. Maybe that was in your budget when rates were 3%, but what if rates are 100% higher, as they are today, 6%? I think that's going to put a lot of stress on people's budgets, especially now that we're seeing a big uptick in companies announcing layoffs. Okay, so I think Snapchat just announced a layoff. A couple of my buddies who work at T-Mobile in the enterprise sales division, T-Mobile just had quite a sizable layoff. Now, I will be fair, this is what I'll say. When T-Mobile was in talks to acquire Sprint, obviously it was a merger, but it was really an acquisition. When T-Mobile was in the talks to do that, one of the only ways that they were able to get that approved is if they promised the FCC that they wouldn't do any layoffs for about 24 months. Well, that 24 months is up. So a lot of the positions that had a lot of duplicity, a lot of times, those are the ones that are first to go. Now, you never want to see somebody getting laid off. It's horrible, and I wouldn't wish it on anybody. But that's unfortunately what we're seeing right now. And I think it's broad-based throughout the economy. The good news so far, and I say so far, is that it seems to be that the people who have been unfortunately laid off are able to quickly assimilate back into the workforce just because the labor market is still running white hot, okay? And we reviewed this last time on the stream. So the labor force participation rate did tick up a little bit, but that was, the labor force participation rate did tick up, but also the unemployment rate did tick up. But the only reason why the unemployment rate ticked up is because there was actually about 600,000 employees, or people I should say, that have re-entered the job market or looking for a job. And I think that's because of increased inflationary pressures, maybe early retirements that were a little bit miscalculated, and things like that, have forced people back into the workforce. So I'll give you guys one more look at the Empire here. Beautiful. This is from East 21st Street, Broadway. Hey, Wendy England says, yes, there are still tons of jobs out there, thank goodness. Yeah, I think that trend may start to change, and we'll talk about that a little bit, but I think you're right, Wendy. Good to see you. Chris Beeman is here. Says, happy Tuesday, Tom and everybody. Good to see you, Chris. Yeah, Pearl Heart Disciples is the 50-year mortgage. Yeah, how long do they want to extend and amortize that? Hey, Jonathan Richards is joining us. Says, hello, Tom. What's up, Jonathan? Hopefully you had a fantastic Labor Day weekend. I see Tiago Pereira is here. Welcome. Jersey Girl. Good to see you. Yeah, Roberta's like, it helps that you can deduct the mortgage interest, though. That is true. So any interest that you pay on your mortgage is, you can take it as a tax deduction. That is 100% correct. That is true. But I mean, if you think about it like this,
it makes total sense.
Here's another thing. I want your guys' opinion on this. So a lot of my friends who bought homes or bought properties, either it be an investment property or their personal home, right? Let's say if they bought it within the last 2 years. So one of the things that they're seeing right now is obviously, you know, I would say the vast majority of people have been expecting this. I think the vast majority of viewers who watch this stream have been expecting this as well. But the taxes have gone up astronomically, right? So let's say if you bought a home in 2021 and your taxes were, let's say, $4,500, just making an example there. And if you bought in one of those very hot markets that were appreciating about 19% a year, which is definitely going to stop. I think a lot of that stuff is over. You know, your tax bill could go up, you know, $1,000, maybe more. Right? So that could potentially add, you know, a couple $100 onto your mortgage payment, thus stressing consumers even more. So if you think about the people who are just now in the market to buy a single family home, we haven't really seen prices come down yet. I think prices are going to come down. You guys know my take on this. But as of now, we haven't seen prices come down. So they're roughly at the same price as they were last year. But borrowing costs have gone up 100%. So if you wanted to take out a 30-year fixed rate mortgage this time last year, you were paying 3%. You know, now you're paying 6%, and you're probably paying, you know, $200 or $300 more on your mortgage payment. So I think that's something to be aware of, something to be cognizant of here. I think something does need to break. You know, a little bit later on in the stream, you know, we're going to talk about a particular interview with a very, very well-respected economist. We talk about him all the time on the stream. Dr. Mohamed El-Erian. Okay, so Mohamed El-Erian did an interview with CNBC a couple days ago, and he was talking about this notion that, ooh, I think that guy hit that. Man, we see some crazy stuff here on the stream, guys. Seems like people just hit the mirrors off and run away. Well, nothing I could do. Anyway. So when we talk about interest rates, one of the things that Mohamed El-Erian has been saying is that he's been very critical of the Fed. He thinks that the Fed needs to continue to raise interest rates with force. However, here's the issue. And Mohamed El-Erian was very direct in his verbiage, let's just say. He's like, ever since the lows of 2008, the market has sort of conditioned the Fed to bully the Fed into capitulating and pivoting. However, the Federal Reserve is unable to pivot this time. So for those of you who don't know what I'm talking about when I say pivot, this is what I mean. So many investors were thinking that Fed Chair Jerome Powell, during his speech at Jackson Hole last week, was going to come out and blow smoke up the crack of this market and say, you know what? We saw one positive CPI print where inflation's coming down a little bit. You know, we're going to take our foot off the gas of raising interest rates. Okay, that would be called pivoting, right? So the Fed has set clear expectations that they're going to raise interest rates 75 basis points at the September meeting. So many investors on Wall Street thought that there could potentially be a pivot. So here's why Mohamed El-Erian says that they should have never expected a pivot. And the reason this time is inflation. The reason this time is we're actually facing real inflation here in the United States. If we think back to 2018 in Q4, what happened? The markets took a nosedive into Christmas. We bottomed on Christmas Eve. I remember this, I was trading it. We bottomed on Christmas Eve. The Fed pivoted because they could. Because if you think about, let's think all the way back to 2018. What was the difference between Q4 of 2018 and today? Well, the Fed was raising interest rates, but they could afford to pivot because inflation was 2.5%, maybe a little less than 2.5%. Now it's 8.5%. You know, it came down since that 9.1% print in June. But that's the difference. So Mohamed El-Erian, if you guys want to watch this interview, I would really, really suggest you watch it, and you'll sort of understand market mechanics here. So if you type !pivot, P-I-V-O-T, in the chat, once again, !pivot, P-I-V-O-T, you'll sort of get a very good understanding of how the Federal Reserve thinks, why there's no negotiation for a potential pivot here because we need to crush inflation, and why were we able to, or why were we allowed to be so accommodative in the past, like in 2018 and 2015. Well, back then inflation was right at the Fed's target of 3%. Now we're quadruple that. So something to be aware of. Oh my gosh, guys. It's the one and only Laytha. Hey, Laytha, good to see you. Long time no see. I trust you're doing well, though. Hopefully you had a fantastic Labor Day weekend with you, your family, your friends. But good to see you, Laytha. Always a pleasure. Thank you so much for joining. So I think it's going to start raining again. I feel the raindrops, so we may have to pull over to the side here and get the old trusty umbrella out. We are now 14th Street, Union Square, outside of the Whole Foods here. Hey, Andre is here. Good to see you, Andre. The Destructionist says, hey, Tom, has it been raining all day? Yes. So it's been downpouring raining all day. And it actually just stopped right as I started streaming, which is actually some good news. Let me see if I can wipe the camera lens here. Andrew H says hello. Good to see you, Andrew H. Sally is here. Welcome. Eve says stay safe. Thank you, Eve. Thank you for joining the stream tonight, Eve. I see my friend Chris Beeman from Arizona. Good to see you, Chris. Wow, everybody, check this out. The Empire State Building is like illuminating the sky with its very stark blue colors amongst the clouds in New York. Looks like Gotham City. Mustafa says, hey Tom, I miss New York City. Be safe, thank you so much. Austin City Limits says, Tom, your voice sounds better. Thank you, Austin City Limits. You know, I've just been getting over this allergy attack that I've been having. I think you guys already know. But I get the same thing every year. Right around September, first week of September, I get clocked, I get hammered, okay? Just like the markets. And it gets me down and out for about a week. But it takes me about 3 days of feeling really crappy. And then the last 2 days, the only thing that really happens to me, or tends to happen to me, is I just lose my voice. So I've been sort of powering through that, drinking an ungodly amount of green tea to the point of where I'll probably never have a drink of green tea ever again in my life, in any event. But I feel good, nothing to complain about. I'm very thankful that I am feeling much better. So this is East 14th Street, my friends. Let's head down to Washington Square Park. Let's check out what's going on over there. Tom Barry is here. This is beautiful, Tom. Good to see you. Hey, Clark Rumsey says, you're so knowledgeable. You're in sales. What do you sell? Do you sell software? How do you know so much about the markets? Did you major in economics? Yeah, so I appreciate the comment. Thank you for watching. So yeah, I am in tech sales. So I say tech sales more generally. I do sell software, but I also sell hardware as well. But yeah, I originally I wanted to work on Wall Street in sales and trading. It's what I wanted to do outside of college. But you know, long story short, I was networking with a lot of my I don't really want to say mentors, but people that I've been working with, people, you know, customers. Long story short, I used to work at a rental car agency when I was a teenager in college. And a lot of the people who would come in to the shop to rent cars from me, and my job was essentially to say, oh my gosh, welcome back. I hope you had a great experience, and, you know, clean up the cars, vacuum them out. And I always be so curious. I'd ask these guys, I'm like, you rent a car almost every day. What are you doing? And like, oh, I'm an account executive at Salesforce. I work at SAP. I work at Oracle. I sell software. And at the time, I had no idea what that was. I mean, if you were to ask me in 2014 what, you know, a CRM software was, I couldn't even tell you what that was. I didn't even know anything about the cloud. Long story short, over the course of a couple of years, I built a relationship with a lot of these, you know, people, one of which was a VP of sales at Salesforce. Developed a very close relationship with them, and he started to throw out some of these numbers that what they're making. I'm like, what? I'm like, no way. He's like, yeah, I mean, if you can, what I would do is I would apply to a lot of account executive positions at either pure play software companies or telecommunications companies, because a lot of telecom companies sell software via the channel or channel partners, right? So let's say if you're selling traditional telecom or wireline into large enterprise customers, you know, a lot of the times through channel partners, through like AT&T or Sprint back in the day, you could sell like, you know, MDM or endpoint, cybersecurity software, things like that. So anyway, long story short, that's how I sort of entered the world of tech sales. But yeah, I mean, I like it. I like it so far. I think the thing for me, even though I am a very big introvert, I'm extremely, extremely introverted, but I'm very curious. So now I sell software and hardware mainly specifically into the large home healthcare agencies, right? And home healthcare providers, or I would just say healthcare providers in general, not exclusive to home healthcare. It could be hospitals, things like that. And I'm very curious about how those businesses work. So it tends to be very easy for me to build a rapport with the customers because I'm just curious about how their business works. So I don't know, any event. But Clark, what about you, my friend? But in college, I majored in criminal justice. I did minor in economics. I took a couple of forensic accounting classes, which I don't really think I did too well in it, to be honest. But hey, EBITDA is here. What's up? Says, hey Tom, hope you had a good start to your week. Yeah, EBITDA, it's been a good start. I am, you know, you guys know me, I always like to be, you know, positive and optimistic, but I am not. I think when I get concerned, I like to bring it to the forefront and be blunt. What I'm seeing right now in the market is very concerning. In the debt market, specifically in the bond market, the movements, EBITDA, and you've probably been watching this today. EBITDA is an investment banker at BAML. I mean, the move we had today in that 10-year U.S. Treasury yield was sick. It's sick. And we blew past the 2011 highs. And I think we could be gunning for '07 levels on that US 10-year Treasury yield. And the reason why that's an issue is because we always say, you know, the debt market is the driver of equities. And obviously, okay, I think we gotta get the umbrella out. I think it's raining pretty hard here. So let me pull over to the side. Allow me a minute, guys. A little bit of an intermission. All right, team, I apologize. I'm sorry. I just gotta get the umbrella out. Give me 3 seconds. Sorry about that. I think the audio may be going in and out. Give me a minute. I think we may have to go without the mic. Let me see. All right, let me know now. Let me know if we are good. Hey, Neil is here, says hello from the UK. Hey, Benji is here. Welcome, Benji. This is, are you visiting or are you a local here? Well, I guess technically, everybody, I'm not a local anymore, right? I moved to Miami. Would you guys still consider me a local? I don't know. If New York disowns me, I guess we're just gonna have to live through that. All right. The only thing we have to worry about, my friends, is the camera lens here. Steven says the mic is good. Copy that. Yeah, EBITDA says we were at 2.7 on the 10-year a month ago, and now it's over 3.34. Debt market usually foreshadows pretty well. Should be interesting. Yeah, and I mean, the yield curve is now extremely inverted. So my issue, EBITDA, is, I think the Fed's going to go until it breaks something. I think that's where it's come to be. And, you know, Bill Ackman, I know EBITDA is not the biggest fan of Bill Ackman. I always get a couple laughs in when we talk about Bill Ackman. But he was on CNBC today. Was on CNBC today, and I think it's important to unpack that. So, essentially, the reason why I wanted to bring this up is because Bill is sort of taking the stance that I've been taking, which is actually different than the stance that a lot of other, notable PMs on Wall Street have been taking. And when I say notable PMs, I am excluded from that category. I'm talking about Bill Ackman. Just to set the tone there. But Dan Tapiero, which I respect a great deal, and I met him, I had the pleasure of meeting Dan at the Bitcoin conference in Miami. I talked to him for maybe like 5 minutes. Really nice guy, and a guy like that doesn't need to pay any attention to someone like me. But he actually took some time to answer some questions. Oh, you're getting some clicks in the mic? Yeah, I think we're gonna have to go out without the microphone tonight. Let me know if it clicks anymore, and then we'll rip the mic out. We'll just have to do it without it. So Bill Ackman, here's his thesis. He thinks that the Fed needs to raise rates till about 4% and keep them there for about a year, right? He's like, that's what the Fed needs to do to kill off inflation. He's like, and that's the right thing to do, and that's what he thinks. That's what I think is the right thing to do. A person like Dan Tapiero thinks the Fed is totally getting this wrong, and that the Fed needs to reverse action immediately, because if we think about what has caused a lot of this inflation, it hasn't been because the economy is overheating, to his point. It's been because we are emerging now out of a pandemic where we had supply chain issues, we had shortages, we had factory shutdowns. So essentially what that means is we had a period here where factories were shut down, we had a shortage of goods, while demand actually stayed the same, if not went up, or increased demand, right? Or increased demand, which I get. So a theory to Dan Tapiero, or even to Dave Ramsey. Dave Ramsey actually came out and was ranting and raving about how the Fed you shouldn't be raising interest rates. But again, I also respect Dave Ramsey. But at the end of the day, you can't just sit back and say, oh, things are going to normalize if we don't do anything. right? To me, that's unacceptable. I'm more along the lines of the stance where you need to go big and you need to jack these rates with extreme velocity, where, yeah, you'll probably break something, the market's probably going to go down 40%, but at least we know that'll probably kill inflation, right? But if you just continue on this path where, like, COVID's going to work itself out, the supply chain is healing, well, how much longer, dude? Because at the end of the day, all of these fund managers here are billionaires and millionaires, and the average American isn't. Okay, and that's my whole thing is, oh yeah, it's going to work itself out, the supply chains are going to heal, don't worry about it, and have the CPI run hot at 9.1% when many Americans are living on a fixed income and a fixed budget, when a lot of these Wall Street guys are not, right? It doesn't matter if inflation's 9% for them. So, I mean, that's my whole theory. And again, I could be wrong, right? And I understand the ramifications of COVID. I understand that supply chains have gotten clogged. I understand that China is still battling with their zero COVID policy, which has now led a lot of American companies to say, whoa, wait a minute. We can't handle this. We're actually going to start domesticating our supply chain now because we can't do this stop, start stuff anymore. And I think we saw that with Apple. We're seeing this with a lot of chip companies such as Intel, Taiwan Semiconductor, Nvidia, and the like. So I don't know. I mean, what are your guys' thoughts? I would say, which side are you guys on in the chat? Do you think that the Fed is going to do overkill and inflation is just going to come down on its own? The Fed could just hold rates here. They don't have to raise rates at all. Or do you think there needs to be some Fed intervention in order for this inflation to be killed? Now, I'm open to any idea, and I admit that I could be wrong. I could be wrong. I'm wrong all the time. But I think it's important to have these conversations. All right, team, we are outside the NYU Stern building. Oh, the mic is cracking? Hold on. All right, guys, unfortunately, we're going to have to do without the mic tonight. So I think the audio quality is going to be very, very terrible. So I apologize for that. Hey, Arctic Trend is here. This is more Fed intervention. EBITDA says, I think JP is going to overdo it and should take his foot off the gas a little. I could stomach the inflation though, so maybe I am biased, but I think that it's better for the markets. Yeah, and I mean, it's an interesting thing. And EBITDA, I think you would enjoy this particular, hey, Manny Explorers, what's up? Good to see you. So EBITDA, I'm not sure if you just came into the chat, but I think you would really enjoy this particular interview with Mohamed El-Erian. You probably know who he is. Very, very well-respected economist. So if you type !pivot, P-I-V-O-T in the chat, Mohamed El-Erian sort of gives his take on the whole situation, why the Fed can't pivot. And if we think back, again, I'll quickly explain it for, because we have some more people in the chat here, but the market, to Mohamed El-Erian's point, he's like, the market has been bullying the Fed since the lows of 2008. And the market has been telling the Fed, anytime we experience some volatility, anytime the S&P 500 is down a couple points, we cry uncle and we need Fed Chair Jerome Powell or whoever the Fed chair is at the time to come in and save the markets. Well, the reason why we were able to do that before is because inflation was at 2.5%. I think everybody here is old enough to remember what happened in 2018. So in 2018 Q4, the markets were tanking, and literally the market bottomed on Christmas Eve. And the Fed was able to pivot and take their foot off the gas and not raise interest rates anymore because inflation was at 2.44%, I think. Now, the Fed can't afford to take their foot off the gas because inflation's at 9.1%. Well, excuse me, inflation's at 8.5%. It's come down a little bit from 9.1, but still, it's crazy. So I think that's why we can't see the pivot. And I think the market needs to come to terms with that. You know, I think the market needs to understand that, look, this time it's different. We can't afford to pivot because inflation is going crazy. Hey, Clarence Jackson is here. Says, I love Mohamed El-Erian, well respected. I think he's fantastic. You know, Clarence and everybody in the chat here, there's a handful of people that when they're on the TV, I sort of drop everything and really listen closely. There's a handful of people because, you know, CNBC has people on the air all the time. And, you know, not to say anything bad about those people, but I think there's some people that are absolutely exceptional. Mohamed is one of those people. Brilliant. Number two is obviously Stanley Druckenmiller, Paul Tudor Jones, and then Bill Ackman. And we actually got to hear from Bill Ackman today on CNBC. Yeah, Manny explores his rainy day, but it hasn't had a lot of rain. Yeah, I mean, it was raining like sideways today, almost all day. It was crazy. Hey, Abdullah is here. Good to see you, Abdullah. Welcome. George Loyas says, greetings, kid from San Diego, California. Looks like great rainy weather. Yeah, I'm not complaining. I mean, we haven't had rain in a long time in New York. And usually, you know, the island of Manhattan, every once in a while needs a good shower. And there's been so much pollen in the air, there's been so much garbage and nastiness that I think we needed a good cleaning. So I'm actually happy about it. Cynthia Beal, good to see you. Welcome, Cynthia. King Flush, welcome. Barry Bell says, Tom, I wish the Fed would sell it better. Their opinion, what he says, causes the market to go one way or the other. Yeah, so Barry, what you just said was a major critique that Mohamed El-Erian said in that interview. So again, if you type !pivot, he said the same thing. He said, my criticism of Fed Chair Jerome Powell is the following. He said, at first, well, I'm not going to say he lied, right? I don't think it's fair for me to say that. But anyway, so here's how the sort of time frame laid out. It was, you know, inflation is going to be transitory. It's not going to be sticky. It's only going to be a couple quarters of inflation, and then everything is going to go back down. What actually happened is we saw crazy acceleration, and inflation went gangbusters. And then it was, oh, no, yeah, inflation is going to be sticky, and now we have to do something about it. So even though, essentially what Mohamed El-Erian was saying is that Fed Chair Jerome Powell is giving the market mixed signals, and he needs to step up like a big boy and come to terms with the market and say, no, look, this is what has to happen. Rates got to go up, party's over, until we kill inflation. And if you noticed in the Bill Ackman interview today, Ackman said, so usually what, man, I forget his name. He's actually a very good journalist on CNBC, but I always forget this guy's name. Andrew Ross Sorkin. I like Andrew Ross Sorkin. And a lot of people say some things. I think he's a great guy. So Andrew Ross Sorkin was sort of probing Bill Ackman to say, look, where do you think the market's going to be in a year? Do you think the market's a buy right now? What are you doing? And essentially Bill Ackman said, look, as of now, we are holding pretty much all the same companies that we've held since we bought them back in 2020, right at the bottom of the pandemic. He's like, I think if you focus on good businesses and if you ignore the noise and if you focus on companies that have good earnings, you'll be able to ride the storm out. However, he did say this right after that. He said, my buy signal is when the Federal Reserve can conclusively say that they have conquered inflation, which does not mean one CPI report that's coming down a little bit. It has to be very conclusive evidence. And the Fed will have to signal to the market that no more rate hikes are coming. So, to which brings me to my next point, everybody, and we talk about this all the time on the streams. It's don't fight the Fed, right? Anytime you have a big heavy hitter on Wall Street come on the news or do an interview, they all say the same thing. And I think a lot of people can overlook that, right? But think about Paul Tudor Jones, Stanley Druckenmiller, today, Ray Dalio, which we talked about, right? But today, most recently, Bill Ackman came out and literally told us without telling us, don't fight the Fed, which essentially means if the Fed continues quantitative tightening and raises interest rates, the market's going lower, it's not going higher, right? So, and if you look at these particular individuals' track records, they're phenomenal, right? Especially Stanley Druckenmiller. So if they're not fighting the Fed, if they're just holding their investments, if they're not making any new investments, well, what do you think we should be doing? Now, I'm not saying, I'm insinuating, but if you look at the overall breadth of the market right now, if you look at the S&P 500, the NASDAQ, the Dow Jones Industrial Average, they're all sitting well below their 200-day moving average, well below their 50-day moving average. And these averages are curling over here, and we're in a very, very clear downtrend. And anytime a leading stock tries to break out or tries to gain some ground, it usually reverses the next day, and it's a failed breakout. And I think it just goes back to this point that it's very, very difficult for a trout to swim upstream. It's very, very difficult for a trout to swim upstream, okay? So what do I mean by that? Well, every Sunday night, after I get off the live stream, so when I take the train back, at like midnight to Long Island, I pull up, a list of charts, and I go through hundreds and hundreds of charts. And the stocks that are showing relative strength right now are a lot of the solar stocks. But what we've been seeing is, yes, they're trading near 52-week highs, but every time they break out, they just reverse back down and get crushed. And if you're trading a lot of this stuff, you can get stopped out and you can get chopped up. And I think it's just, if you're trying to buy breakouts here and trade this market, you just gotta come to terms that your probabilities for success are reduced, because if you have the major indices in a screaming downtrend getting hammered, if you have that 10-year treasury yield taken off like a freaking rocket ship, you have more factors against you than for you, right? So just think about what it was like to trade during 2020, when the indices would follow through with crazy volume, and you would have almost every single stock in the indice following through as well. It's sort of like you want the wind in your sails, right? You want the overall trend with you. And I think it's very difficult here. And I've been getting stopped out a lot as well, swung around. It's been a very difficult year. I think we just need to come to terms that if you're gonna try to put on a position here in a leading stock that has good earnings, maybe only risk like 1% of equity, right? Because if you get stopped out at 7%, you're only losing 7% of your 1% of your overall equity curve, right? So, I don't know. A little bit of a tangent there, but those are just some of my thoughts. So now we are on West Broadway, headed down towards Soho. Hey, Edson is joining us here. Good to see you, Edson. Welcome. Jimenez, welcome. Good to see you. Hey, Amar is here. Says, hey, Tom, when are you returning to Miami and doing the live streams from there? So I'm not sure as of yet. I do have a couple of things to take care of here in New York, but usually, generally speaking, we do about 50% of our time in Southern Florida and Miami, and 50% of our time here in New York. Hey, check it out. Good to see you. Clarence Jackson says, I'm all about value with a lot of cash. Love that, Clarence. Yeah, Latha makes a good point. So Latha says after Labor Day, it's all business in Manhattan. Yeah, so usually, and this is why September is very could be very dangerous. So yesterday on the stream we talked about the average performance of the overall major indice, right? So let's just say the benchmark S&P 500 is right around negative 1.5%. Ooh, the rain is starting to pick up here. But now with the Fed tightening, with interest rates going up, I think it could be a rougher than usual month, I would say. Rougher than usual. Perhaps. Maybe I'm wrong, but we'll see. Yeah, Steven, yeah, it's like, be careful, lots of oil on the roads. So you know what I want to do, everybody? Oh, Junior is here. It says, good evening, Tom. Send some of that rain here to Sacramento, California. It was 117 degrees today in Sacramento. Oh my God. That is insane, dude. Well, I think we need some of the rain here. It hasn't rained in a long, long time in New York. Anyway, if you guys are enjoying this live stream tonight on this very rainy day in Manhattan, feel free to leave a like on this video and hit the subscribe button if you're new. We usually do these live streams about 5 days a week between New York City and Miami. We'd love to have you here. So now that we've been talking about interest rates, inflation, the stock market, I want to turn our attention here to a very, very well researched and thought out article that was published this Saturday in the Wall Street Journal. And I wanted to call this out because, and I want to preface this by saying, I'm not necessarily saying we are now entering a market very similar to the stagflationary times of the 70s and early 80s, but I think there's a possibility. And I think many people on Wall Street also think that's a possibility. You know, just for the fun of it, let's see how much these things are. We'll take a little bit of a break. We'll see how much these are. So for a Mint, West Village 3-bedroom, a 3-bedroom, 2-bathroom could be yours for a small price of $2,795,000. Fantastic. This 3-bedroom, 2-bathroom could be yours for $2,295,000. It's not bad. Sounds like a pretty smoking hot deal to me. This 1-bedroom, 1-bath could be yours for $660,000 with a very small maintenance fee of $1,640 a month. Make of that what you will. Yeah, JP's like get excited. Yeah, Rare Bear says I'd rather have a lake house out in the woods. Yeah, I think it's just your personal preference, right? I mean, some people love the city. I love the city too. I'm not gonna say I don't love it. I love New York City. But New York City commands a price, my friends. New York City commands a price. Anyway, so I want to share with you this particular article that was in the Wall Street Journal that I thought was absolutely fantastic. So if you type !stagflation in the chat, the Nightbot will drop the article that we're going to be talking about now. And the article is written by a very, very well-renowned journalist. Hold on, let me wipe the camera. By the name of Jason Zweig. Now, I may be mispronouncing his last name, but if you go on YouTube or open up another window and you type in Jason Zweig, he is a wealth of knowledge. He is a fantastic journalist, fantastic columnist, and he wrote this piece in the Wall Street Journal this weekend that was comparing the market environment between, let's say, roughly 1966, late 1960s, throughout the 70s of the stagflationary environment, and said, okay, let's look back at what particular stocks perform the best. So if we think there's a possibility for us to go into an environment of stagflation, well, I think it would be appropriate to look back throughout history to see what particular stocks performed rather well. So just to give you guys some perspective here, let's take a trip back to February 9th of 1966. The Dow Jones Industrial Average closed at roughly $995.15 on February 9th of 1966. So fast forward 16 years later, roughly on August 12th, 1982, the Dow Jones Industrial Average actually bottomed at $776.94, all while inflation was going gangbusters at around 7% per annum or annually. So think about that. That's almost a 16-year spell where the market made absolutely no progress, okay? And that is called a stagflationary environment, when economic growth stagnates and inflation runs wild. Now, I gave you guys a hint. Last night on what the best performing stock of that time was, or that period. So I'll see if you guys remember. So what was the single best performing stock on the exchange from 1966 to 1982? Does anybody remember? The single best performing company, or the single best performing stock from 1966 to 1982. Well, if you don't remember, I'll tell you. And again, I'd really advise you to read this article. It's very well researched. Yeah, Chris, you're right. Tandy. Chris is right. His3 is right. Tandy or Radio Shack. So Tandy was a publicly traded company, now known as Radio Shack. I mean, they're out of business now, but at the time, they performed the best. So they returned about 14,175% over that period. And many of you must be thinking, well, if I think back to that stagflationary environment, oil went crazy. So crude oil went from about $3 a barrel to I think right around $42 a barrel, I think from 1966 to 1980. So if you're saying, if I was long energy, I probably did well. Yeah, you were right. So Texas Oil and Gas produced a return of 3,650%. Right, that's no surprise because we had a massive bid in oil. But we also had major... I'm trying to figure out which way I want to go here. I think the weather's terrible, so I think we're going to head back. But this is Prince Street and Broadway, everybody. But I think we're going to head back uptown now. So the second largest winner was a company called the O'Sullivan Corp. And it is a plastics manufacturer that also made a ridiculous return of 4,820%. So why am I sort of bringing this topic up, right? Now, I think the reason why I'm bringing this topic up is because as it reads in the article, right, I think Jason does a phenomenal job. The consensus on Wall Street is during an inflationary environment, you want to buy the companies that have the best pricing power, right? That's what everybody will tell you. If you look at any investing book, any economics book, it'll say during times of inflation, you want to buy companies that have extreme pricing power. But I think what Jason does a good job in writing this article is that, Tandy Corporation didn't have the best pricing power. It had a disruptive product or service that met a market need, and its earnings quadrupled during that particular time. So I want to read you a quote from the article. Man, it's getting windy here. I wish we had the mic. The audio probably sounds not good, but it's been a crazy weather event. Let me try to plug in the microphone one more time. Yeah, I think the mic is going to be out on us. It's unfortunate because it's windy, but there was a particular quote from the article that I think is quite relevant to today. And it reads, "History never repeats itself exactly, but you're more likely to defend against inflation by buying what is cheap now than by buying what is already inflated." And so what that quote means to me is that, you know, if you look at all these companies with pricing power, right? Like a lot of the healthcare companies that we talk about, you know, a lot of that price is already baked into the cake. So I think the article does a good job of putting things into perspective to say, look, at the end of the day, stocks are businesses, and we need to think about these particular stocks as businesses. And it goes back to what we talk about all the time on these live streams, is that at the end of the day, if a company is compounding out their earnings and blowing out their earnings, growing their earnings growth, growing their EPS, has fantastic pre-tax and after-tax margins, over time that stock is going to go up, generally speaking. I know there's some nuances there, I get it, but generally speaking, if a company earned $2 last year and they're slated to earn $10 next year, that stock is probably going to go up. And that's exactly why I was very surprised to see that, you know, Tandy Corporation was one of the best performers during that stagflationary time, you know, beating out some of the oil companies there. And it just goes to show you that no matter what market environment it is, if you have a company that has a disruptive product or service that can compound out its earnings and really blow it out, there's still opportunities to be had, even though the general market has gone sideways for 16 years. So I think it's just a good refresher. Once again, if you guys want to read that particular article, if you type !stagflation in the chat, I think Jason Zweig does a fantastic job with sort of explaining the particular stocks that produce the greatest returns during that period, and to sort of bring us to a level head to say, look, even though things are going to get bad, times are tough, you know, American capitalism always wins out in the end. There's going to be entrepreneurs that wake up every day, that go to work, that engineer new products and services. People are going to buy those products and services. Those companies are going to need to go public, and those companies are going to have blowout earnings reports. They're going to beat on both the top and the bottom line. They're going to raise forward guidance. So I think even if things get bad, as we've been talking about, the debt market is looking like it's going to implode. America's been through worse things. We've been through world wars. We've been through a coronavirus pandemic that killed millions of people. We were forced to be locked into our homes. We made it through that. So I think whatever's next, even though we may go through some turbulent times, maybe the market goes down 40%, I think we'll get ourselves out of it. So anyway, check out that article. I thought it was very well written. Hey, GM is here. What's up? This is Hey Tom checking in from LA. GM, how's the weather in LA? A lot of our other viewers from California have been telling us that it is a crazy heat wave, about 117 degrees. I think you guys are on a power grid warning or something like that. Dusty Cole is here. Good to see you. Sabrina Ferris says, nah, it's going to be brutal. Just buckle up. Yeah, I mean, it's very possible. I mean, the way the debt market is acting, it's that's classic instability there. You know, that's an uncontrolled sell-off in the debt market. So we'll see. Mike MTL says invest in water. It's actually probably a pretty good idea. We were actually talking about a particular investing thesis to buy land in upstate New York near the Finger Lakes region. Wow, Ryan is like, or Robert says, Tom, I just got a notification on my phone to start conserving power. My God. You know, that's another blunder that our government did to us is, demonize the cleanest and safest form of energy production, nuclear power, and we've somehow managed to demonize that process, which is egregious. That is a, anyway, I don't want to get too political, but. All right, team, this is one of my favorite coffee shops, Gasoline Alley Coffee here. Hey, Rare Bear says, Tom, the Finger Lakes are beautiful. Some of the cleanest, not only in the country, but in the world. Agreed. Could be a good play to buy some land up there. Layla says, yes, Tom, we've received a reduced power warning over our cell phones at 6 p.m. here in California. Oh my God. Hey, Kel Shreen says, hey, Tom, I'm kind of hoping living in Michigan, maybe our greatest lakes, will turn into Middle East oil industry and we'll all become rich just based on our water. Hey, I mean, I think you may be right. It's possible. It's possible. Yeah, Robert A. says there's nothing political about talking about nuclear energy. Just ask the Germans. I know. Yeah, and here's my thing, everybody. And you know I try to be respectful of everybody's views, and I am respectful of everybody's views. But at the end of the day, if you really care about climate change, the only thing to solve climate change is nuclear power. Literally zero emissions, the cleanest form of energy you could get. And look what we have to do now. We actually have to revamp some of our coal-fired power plants to make up for some of the lack of energy production. And here's the last thing I'll say about all of the climate situation. I am extremely bullish on green energy and clean energy, but I think we need to do it in a way that's smart, that's not going to crater the global economy and kill a bunch of people, right, and make people freeze to death. And I also think we need to be on the same page as a global agenda, because if you look at China, they're building more coal-fired power plants than ever before. So what good is it going to do if everybody else is trying to do the right thing and clean up the environment, and we have other people doing the opposite? So, I know, I think we could be more aligned on that aspect. So one of the things I love about NoHo and Soho are these beautiful original cobblestone streets. Some of my favorite here. Yeah, dusty coals like wind, solar, and water. Yeah, I mean, the thing about that, and I'm a big bull on them, right? Love solar power. The only problem that we have now is the lack of the critical infrastructure to store the power that is produced with solar energy, right? So we could produce as much energy as we want. We just do not yet have the battery technology or the infrastructure to store that energy to be used at a later date, at a later time. And I think that technology is coming, and I think we should be investing in that technology. Now, going back to the stock market, something that I'm noticing is a lot of those particular solar stocks are trading near 52-week highs, which is telling you something, right? Which is telling you something, but I don't think, essentially you need to do it, and I think Steven Schwartzman said this best. So Steven Schwartzman is the founder of Blackstone. He said, look, everybody's on board with going green, but you need to do it in a way where you're not going to crater the economy. Let me wipe the the lens here. We're battling with a little bit of a rainstorm here, everybody. Hey, Lex F says, hey Tom, I absolutely love New York City. They have New York City accents. They have something very commanding about them. This is Lex S. Hey, Finger Lakes, New York is here. Funny enough that you're joining us, my friend. It says, hey Tom, drinking water comes from Seneca Lake. It's one of the Finger Lakes. Yeah, I think one of the cleanest lakes in the world, not only in the United States, but in the world, is a lake called Skinny Atlas Lake. Which is up there in the Finger Lakes region in New York. Tony Jones is invest in QuantumScape. Good to see you, Tony Jones. So Austin city limits, I did see that. So there was some news out of California that by 2035, there will no longer be allowed to have gasoline vehicles be sold in California. So as an investor, and this is, I try to get this point across to the group. So as an investor, right, if you're thinking as an investor, right, not as a political analyst, but a financial analyst, we don't really care what the government does. What we try to do is assess the situation from what the government is doing to then deploy capital in the most appropriate ways to capitalize on where the government is forcing capital flows to go to, right? So based upon that thinking, and again, this is why I always like to look for relative strength in the market. You have a lot of these renewable stocks, clean energy stocks, solar stocks, trading near all-time record highs while you have the market getting pounded. It's sort of like, follow the money. This goes back to our live stream. If you guys remember, I think 2 weeks ago, we did an entire live stream about the Inflation Reduction Act, and the live stream was titled Follow the Money. Right, so based upon all of the government subsidies, all of the government, you can pretty much call it intervention and investment. It's all going to a very, very select few things. And I think that's where a lot of the investment flows are going to flow. So I think we need to all be aware of that as well. Hey, Blue's Writers here. This is invest in the Midwest as everybody eventually flees the over-regulated coasts. Well, I think there was a gentleman on the live streams at one point where they were talking about the very fertile farmlands in the United States, how that is going to be very coveted territory. And you're already seeing a lot of family offices, such as Bill Gates and the like, buying up a lot of the American farmland, because I think it's going to be so critical over the next couple of years. And I think it plays into my thesis that, man, it's getting windy. I think it plays into my thesis that, the Finger Lakes could be a pretty decent investment. Hey, Jeff W., good to see you. Man. So I want to ask you guys in the chat, how is the audio tonight? Is the audio okay? Because I know we had to rip out the microphone. So I hopefully I'm not annoying you guys tonight. I got to get a new mic. Jeff W. Horatio Snipes, good to see you, my friend. Welcome, Horatio. The audio is good. There's no wind noise. Fantastic. Love that. All right, team, now we are at Astor Place here on the corner of Lafayette Street, outside of the Starbucks. Hey, 925 says the weather in Miami is treating us nice. Yeah, I got to get back down to Miami. I'm definitely missing it on a day like today. Normus, this sounds good. Appreciate it, guys. Thank you, thank you. So I wrote down some historical bond yield. Oh man, it's windy. Hey Herbert, thank you so much for the $2 donations. His audio is great. Narrator well. Thank you so much, Herbert. I appreciate that very much. Thank you for the support. As we pass the IBM building here. You know, this reminds me of one of those days in February when it's really just raw out, it's nasty out. The good news is it's actually pretty warm out. That's the only thing we got going for us tonight. It's pretty warm out, so. So here we are at the IBM Watson building. This is 51 Astor Place. I told you guys a million times, I actually had an interview with the IBM Watson healthcare team. Thankfully, that interview didn't go well because the IBM Watson unit was then sold to PwC, and I think a lot of people were laid off. So we've been talking about the instability in the debt market today. That 10-year US Treasury yield is now at 3.342%. Obviously, the yield curve is inverted with the 2-year Treasury yielding about 3.509%. If we look at housing, if we look at that 30-year fixed rate mortgage, the average 30-year fixed rate mortgage as of today is 6%, 6.02%. Now, what I want you guys to do, and I think this is a very good resource, don't worry, it's free. I try to give you guys as many free resources as possible. So if you go to tradingview.com, it is a 100% free trading software or a charting software. And I want you to pull up a chart of the 10-year US Treasury yield. Now notice I said the 10-year US Treasury yield. Okay, so not the bond, but the yield of the bond. And I want you to go to a monthly time frame. Okay, so zoom out on a monthly time frame here. And you'll notice something very, very important. And here's what's so important about it. So today, we broke out with extreme force over November 2018 highs. That was roughly 3.25%. You know, let's go on to the scaffolding. I think we'll get out of the rain. And if you noticed about 2 months ago, or at the beginning of June, that 10-year US Treasury yield actually went up and tested that level at about 3.25%, and we actually came back down a little bit. And if you notice the correlation here, so here's what I'm trying to do. Okay, notice the correlation between that 10-year US Treasury yield and the equity market, so the indices, the stocks. So we had a massive summer rally, and that actually correlated with a pretty nice drop in that 10-year US Treasury yield. Now, what's happening now? The moment that bond market started to sell off here, okay, people started dumping bonds. As we know that bonds have an inverse correlation with yields, so as the prices of bonds go down, yields go up. Usually cash flows out of the stock market. What have we seen? Now that the yields have been going up, bond prices have been going down, stocks have been going down. So it's an interesting correlation there. But if you zoom out to a monthly time frame on that 10-year US Treasury yield, look where the 10-year was trading at in 2007. We were trading at right around 5%. And there's not a lot of resistance. There's a pretty big air pocket from where the 10-year US Treasury was trading at, or the yield, from now, after we've cracked those highs in 2018 to where it was in June 2007. So it's very possible we can have a pretty abrupt sell-off in this debt market and yields spike to 5%. Now, I'm not saying it's going to happen, but I think we need to be prepared for that. Because again, if you go to tradingview.com, or I think if you even go to cnbc.com, you just pull up a long-term chart of that 10-year U.S. Treasury yield, pull up a monthly time frame, you'll see what I'm talking about. There's really no resistance until 5%. So just be cognizant of that. Hey, Natalie is here. Good to see you, Natalie. Welcome on this extremely rainy and windy day in New York. Yes, Clenstrine, I'm looking at that. GM says, Tom, are you a CEO of a large investment firm? No, I am not. You know what? From like a cinematography point of view, this is actually a pretty nice shot. Not gonna lie. It's a nice shot with the guy holding the umbrella for the girl. It's pretty nice. I like it. But we're gonna bang a left here because I want to show you guys the Strand bookstore. Yeah, Natalie's like so gloomy. I love it. Yeah, it reminds me of sort of like the late February weather when the snow is sort of melted, but it's a raw day. It's like a wintry mix. It sort of looks like that. All right, team, I got to tell you something. So today I actually came to this bookstore, Strand. I love this bookstore, by the way. And I wanted to buy a particular book by Paul Volcker. Now, it says that they had one particular copy left, but when I went in there, you know, the very, very nice employee helped me look through the entire place and couldn't find it. So it's in there somewhere, but I just can't find it. But anyway, one of the reasons why I wanted to buy this particular book by Paul Volcker is because obviously I've been hammering on this quite a bit, but I sort of want to make the point. You know, as we potentially move into this stagflationary environment, I want to read and consume as much content as possible from the person that was in charge of fixing the mess. So let me say that again. Let's just assume we are headed into a stagflationary environment. I want to read and consume as much content as possible from the one man on the planet that was tasked at the time with solving the stagflation problem. And that gentleman was Paul Volcker. So he has a particular book out. I'm blanking on the title, but that was going to be the book recommendation for the stream. But knowing me and knowing how forgetful I am, I forgot the name of the book. So typical of me. However, if you just type in Paul Volcker book, I think it's the only book that he's written. And I think it's very important that we all read that. Now, you could probably get it used off of Amazon for maybe $2, something like that. But sometimes I like to go into the bookstores. Anyway, long story short, they supposedly had one copy, but we couldn't find it, so I left empty-handed. So I may have to go to a bookstore on Long Island and get it by Paul Volcker, and I recommend it to you guys as well. Ah, yes, it's called Keeping at It. You're correct. It is called Keeping at It. It should be about how to govern efficiently or something like that. Very, very good book. The Quest of Sound Money and Good Government. Correct. Team, check that out. Empire State Building amongst the clouds. Fantastic. Love it. 10 out of 10. I give that a 10 out of 10. Even though there's some obstruction with the trees, the contrast with the clouds gives it a 10 out of 10. Hey everybody, we have Melissa 2087. Good afternoon, Melissa. Hopefully you had a fantastic Labor Day weekend. This is Tom. What street is this? This is East 14th Street and Broadway. We are now approaching Union Square, where we will head back uptown towards 34th Street. Hey, Mr. Favre says that's on deck after I read Principles by Ray Dalio. Yeah, Principles is also another very good book. Very, very good book. So here is the main Union Square building. Hey, Jose Da Silva is here. Welcome, good to see you. Mr. Favre 85, thank you for joining the live stream tonight. Tony Jones. Yes, this instead of cash cab, we're on walking cab. Maybe we'll have to make our own game show. Everybody, we have our pal Robert Parker joining us. Good to see you, Robert. Yeah, Dr. Longus is like keeping at it, Tom, even with the allergies. Yeah, I mean, the allergies have all but subsided. My voice is a teeny bit taxed, but not too bad. Not too bad. I think just maybe one more day of, unfortunately, drinking green tea, I think we'll be ready to rock and roll. EBITDA says, hey Tom, I'm reading 48 Laws of Power. It's very fitting for investment banking. You should check it out. Yeah, so I've read it. It's very good. It's very, very good. I've read it. That is, it's definitely a good book for investment banking, and I think sales in general, if you are a salesperson, which at the end of the day, investment bankers have to have a very, very high level set of sales skills, negotiation skills, persuasion skills. Denise, New York City says, Tom, did it stop raining? It finally stopped raining. It's not even misting. So on that note, I'm actually going to put away the umbrella. Here's a nice Tesla for everybody. Lex S says, we're not seeing any scooters in New York City. Many European cities are inundated with them. Well, I think the electric scooters are banned. So if you guys notice when we do our live streams in Miami, there's hundreds of those scooters laid out all over the place, like these electric scooters everywhere. But in New York, there's none. And I think that's actually probably for good reason. I mean, Miami's not a big walking city. Very seldom do you see as many people walking around on the streets of Miami as you see here. So I think if you also had scooters laying around everywhere, it would be utter chaos. Hey, Millie says, hello. Hope everybody had a nice Labor Day. I did. Definitely had a good Labor Day. So everybody's pretty much back into the office now. You know, once again, that interview that we were talking about with Bill Ackman of Pershing Square, you know, one of the questions he was asked in the interview was, are you making your employees return back to work? And Bill Ackman said very sternly, yeah. You know, this is the first day everybody is back to work. But usually on Wall Street, it is very, I would say it's consensus that everybody returns after Labor Day. Usually everybody comes back from the Hamptons, everybody comes back from Connecticut, and it's back to work. And that's why you see volumes pick up on exchanges. But what he did say is, look, we realize that it's a new normal. So everybody at Pershing Square is back to the office. But, you know, if you're feeling sick, if you have a cold, it's very obvious you're not coming to work, right? And I am so glad the world has changed to that if you're feeling sick, you're now totally good to go to stay home. Because I remember early on in my sales career, I would have to go to work, and I'm talking about I was deathly sick. I'm talking about like delirious. And you would have to be in the office or the boss would ream you out. And it was so counterintuitive. And now everything is just totally flipped on its head. It's crazy. So I think it's good. You know, everybody's back to the office, but look, if you're sick or if you have a family matter to attend to, if you have something, you know, with your kids, if you want to take your kids to school, then yeah, there's some flexibility there. So I definitely am optimistic for that. Hey, Lockjaw, good to see you. Happy Tuesday afternoon, Lockjaw, good to see you. Line Sync is here, welcome. Kel Shreen says, Tom, I don't think I'll ever take a job again where I'm required to be in the office. Wow. Well, I think a lot of people feel, I'm not gonna say a lot, but I think a lot of, like, some people have your point of view, right? Now, for me personally, I kind of enjoy being in the office amongst people. Maybe that's just because I'm in sales, but generally speaking, I think if you can do your job just as well remote, I think you should have the flexibility to work remote. Hey, Mr. Vahid says, hey, Tom, good to see you. Welcome. Yeah, Andrew says, not realistic. People are still going to work sick. Melissa says, Tom, I like being in the office too. Too many distractions at home, especially with a dog. Yeah, I mean, I could see if you're like, one of my friends actually had a baby last year. 2 years ago, excuse me. And she's like, it's been really nice to be able to just stay home with the kid and not have to pay for, babysitting. Childcare is a huge, huge expense in the United States. And if you have a job that allows you to stay home with your kid, take care of it, well, not only can you still do your job, well, you don't have to pay thousands of dollars for somebody to take care of your child. Now, I know it's different for everybody, but I wouldn't be surprised if it cost over $2,000 a month for childcare in America. I would not be surprised. But everybody, check this out. East 20th Street. We're about to see an amazing view of the Empire State Building. 10 out of 10, beautiful looking blue. But first, we are going to be treated to this amazing Tesla. Love the Tesla. So Des77 says, Tom, I'd rather work from home and save the money from commuting and also the stress. So that's been another thing, especially in New York, as some people say that the subways are not safe. They'd rather work remote and not have to deal with the subways because there's been a lot of crime. So I get that. Charles D says, working from home is one of the few benefits of COVID. I know. So Kel says, yep, the amount of money saved on gas and time saved from driving back and forth. Yeah, so you say if you were offered a job that paid $30 an hour as opposed to $35, you just take the lesser paying job because it was remote. Yeah, I think that makes sense. I think a lot of people would agree with you. Wow, everybody, if you think this view is out of this world, feel free to click the like button on the live stream and please subscribe to the channel if you are new. We usually do these live streams about 5 days a week between New York City and Miami. Celeste Benitez says, good evening, everybody. It's my first time here. Hey, good to see you. I started work from home in 2016. I think if you had a loss of a close family member, you would not want to work from the office. Oh man, you lost your spouse due to COVID. I'd rather work from home. Well, first of all, I'm so sorry for your loss. I couldn't even imagine how stressful that must have been for you. But, you know, hopefully, as they say, time heals all wounds. Hopefully, you know, as time goes on, you'll start to recover from that. But I'm so sorry for your loss. Seriously, I hate hearing stuff like that. I'm so sorry. Wow, this is a really nice view here. Roger Fitz says, Tom, if you have a job where you don't appreciate the social aspect of going to the office, you have the wrong job. Wow. That's actually an interesting way to think about it, to be honest. So here's where I agree with your take, and I'll also disagree with it at the same time. I think, and I've said this many times here, now, I'm 27 years old, and when I was very, very early on in my sales career, selling tech or selling software, I don't think I would have exceeded to the level that have exceeded in my career if I wasn't in the office all the time. And that's because what I did when I was in a very, very young account executive is I would always look at the leaderboards, who was the best salesperson in the office, and they made sense, I would ask to tag along. And I think if you're a young person and you're in sales or in investment banking or something like that, it's hard for you to develop your network and relationships if you're sitting behind a computer screen. You got to go out there and sort of take what's yours and build your book of business. Now, maybe some of you are more talented than me, which I'm sure you are. But for me, I think I would have a very hard time getting my start if I didn't, you know, talk to the best performers in the office. If I didn't actually go out and meet customers in person and see how, you know, the best salespeople in the office handled those objections in person, right? I think there was a pretty big value in being able to sit alongside of the best performers, ask them questions, provide value to them. I think I would have a very hard time doing that if I had to do it remotely. That's why I sympathize with a lot of people that were graduating college during COVID. I mean, I think you were at a very, very big disadvantage. Now, again, I mean, if you're a software engineer or something like that, and you're just coding and you're just sitting at your desk, then maybe it's a different story. But if you're in like a frontline sales, revenue generation role or in investment banking, I think you kind of need to be in the office. I think especially when you're young. You know, let's say if you're a managing director or something like that, you've been doing it for 15 years, then yeah, you could stay home. You've sort of earned your keep. But if you're a young account executive, if you're a young analyst, how are you going to build relationships if you're not in the office? I don't know. What do you guys think about that? Yeah, so Wendy England says sales is also very face-to-face, as is retail. Man, the Empire looks beautiful tonight. Hey, Andy is joining us from South Korea. Good to see you, Andy. Welcome, welcome. Hey, Jimmy's here. This is Tom. Landed a job that allowed me to operate with a team in office or work from anywhere is now key, and that would have been almost impossible to attain pre-COVID. That's a good point. I think my chat is a little bit messed up, or maybe there's just a lot of chats. Hey, EBITDA, this is Tom. I switched from Morgan Stanley to Bank of America right before the start of the pandemic. It wasn't until I got back in the office that I really got to know my team. Yeah, I mean, especially EBITDA if you're going on like outings, right? Like a team event, you're going to dinner, something like that. think you make a good point. FaceTime is very important, as you said. Hey, thank you so much for the 20 SAR. I appreciate the donation very much, and thank you for watching. Vic J says hello from San Juan. Welcome. This is great video. Good to see all of our friends from San Juan. Good to see you. All right, guys, I'll let you choose. Should we walk up Broadway tonight, or should we walk up Fifth Avenue? Now, keep in mind, I will tell you this. If we walk up Fifth Avenue, you're probably going to have a little bit better view of the Empire. But there's probably going to be more people and more things to see on Broadway. So I'll leave that up to you guys. Fifth, seen a lot of Fifth. Fifth Avenue, Vonda Howard. All right, we'll start up Fifth Avenue, and then maybe we'll cross over to Broadway a little bit. I think we're split about 50-50 between Broadway and Fifth. Well, we'll go up Fifth because we haven't been up Fifth Avenue in quite some time. Yeah, Latha, you're right. This is near Madison Square Park. I think it's actually starting to rain a little bit again. It seems like almost every day we walk up Broadway, so we'll give Fifth Avenue a try. I do want to, so as we were on the topic tonight, everybody, of Tandy or Radio Shack, obviously we talked about that particular Wall Street Journal article that gave a very, very nice outline or detail of the top performing stock of the stagflationary environment, which was Tandy, which is now known as Radio Shack, but Radio Shack is now out of business. And that stock went up 14,000%. Oh, this is a good shot. I think this is the money shot of the night. Now, if you remember why, what really spurred much of the earnings growth for Tandy, it was Tandy's TRS-80 desktop microcomputer. It was one of the first personal computers to hit the market between 1976 and 1982. And from that product launch, Tandy's earnings roughly quadrupled, not because of pricing power, but because the business boomed in a stagnating economy. So if you guys want a couple laughs, check this out. This is the, that's the computer. So just think about, keep this into perspective of how much technology has changed over the years. So this was the product that everybody was all over. And when I look at something like this, and when I look back throughout history, it sort of reinforces the concept of just how fast technology evolves. Amazing of where we were, that this was the hottest new product on the market. And now we have technology where we could stream live to over 800 people from the palm of our hand. It's really just insane how technology evolves. Bagels and walks is like, Tom, imagine saving files on your cassette tape. I don't even think I've ever used a cassette tape. Yeah, so you guys are saying love the Empire State Building with the mural on the left. I do too. That's a really good shot right here. Miss Benitez says, I don't want to date myself, but I remember saving files on a floppy disk. Robert A. Because I'm old, but I missed that stock also. Funny. Vonda Howard. No, not to make you feel old at all. So for some context, I was born in 1995. So I wasn't exactly using those type of devices. Wow. So Leigh, this is Tom. I remember learning basic computer language in high school. I think that's the first programming language ever. Like BASIC was the first programming language ever. That's insane. That's crazy, Leigh, though. Wow. Hey, Lewis is here. Good to see you, Lewis from Brazil. Lewis, what are your opinions, thoughts? Empire State Building. 0 out of 10. What's your score? I think it's a 10. I think it's, and very rarely do I ever give a 10. You guys know that. Usually I'm right around like a 9.7. But I think this is a 10. Another nice Tesla here. Wow, Dr. Longest says, Tom, the TRS-80 was the first computer I used. Oh my God. So okay, I'll give you, here's an ancient piece of technology that I actually used back in middle school. And I remember it was like the biggest thing that happened during middle school. Our school got some sort of grant from the government. And our school bought like 300 Danas. Does anybody remember the Danas? D-A-N-A? Dana? They were these little like notebook type computers, but it didn't fold. It almost looked like a Frisbee, and you would practice your typing on it. And I thought I was the coolest person ever. And I remember we weren't technically allowed to bring home the Danas, but I would bring it home anyway and like show my siblings. And I would just type my name like repeatedly over and over and over again. And that's really all you could use it for, is just typing. Maybe it was a New York thing. I'm not sure anybody in the chat is around my age, but that's what they were called. They were like these little Frisbee things, and they were called Danas. And you would practice like your typing on it. And you would try to get, you know, X amount of words per minute, things like that. Wow, so you guys, so never heard of it. Interesting. Lauren M, yeah, those colored. I don't think I've ever used them. I know what you're talking about, though. Oh my God. Yeah, I think you're right. They're like these little $95 laptops, but they don't open. It's literally just like a Frisbee. How about typewriters? So I'm actually in the market for a typewriter. I'm being serious. Because I want to put it, I don't really have a library. I just have a dedicated room of the house where I put all my books. So what I want to get, has anybody watched, I'm sure you guys have watched the movie before. Those original movies, the Wall Street movies. Now, Gordon Gekko always sits behind that beautiful, like, red oak desk. I want to get one of those desks, and I want to put a typewriter on it, and have one of the original old Wall Street offices, where everything is that very old wood paneling on the walls, and you have put all your books there, like those bookshelves. That's sort of what I want. That's sort of what I want. So I think over the next 5 years, I'm going to slowly build that out. kind of like that look. I'm sort of going for like a New York Public Library, Stephen Schwartzman style look. I think it's makes a good environment to read, study. Yeah, Wendy England's like, Tom, you're so retro. I just think, I don't know, for some reason, I just love that sort of era where those desks are, you know, I do have a standing desk, but I don't know, I like the look of those big, clunky red oak desks with the lion heads on it. I think it looks interesting. Hey, G Shep is here. What's up, G Shep? Ooh, D, I didn't know that. So D says James and Carla collects typewriters. I'm gonna have to hit him up. You know, maybe that's actually a better description. Yeah, the resolute desk in the office, something like that. All right, team, so now this is Koreatown, one of my favorite locations in New York City. So I do want to briefly give you those Nightbot commands. So we covered three distinct pieces on the stream, one of which was the Wall Street Journal article. So if you want to read that on your own time, if you type !Stagflation in the chat, the Nightbot will drop that. If you want to watch the Mohamed El-Erian interview, where he talks about why the Federal Reserve cannot pivot, if you type !Pivot in the chat, the Nightbot will drop that link. And if you want to watch, last but not least, we covered the Bill Ackman interview today on CNBC. Please type !Ackman in the chat. And those are the three topics for tonight's live stream. You know, there's actually a lot of people in Koreatown tonight. Check out Gray Street Cafe over there. Hey, Brian is here. What's up, Brian? Hope you're well. Always a pleasure to see you. Hey, Bina B is here. Good to see you. Yeah, it's definitely, it's nice to see that the sanitation is finally coming to pick up all the garbage, for sure. Is that true? 14,000 tons of New York City garbage every day? Oh my gosh, I think we got to give the sanitation department a lot more credit. So here's the H Mart, one of my favorite grocery stores here. Line Sinks, Tom, is 720p intentional tonight? No, I think we should be streaming in 1080p. Let me check. Yeah, I think it says 1080p. Maybe I would just refresh the page. We have been having some technical difficulties here on the live stream, so. Yeah, Vonda Howard says, I love H Mart. I do too. The good news is that they opened up an H Mart on Long Island. But it's in a place on Long Island where it's very far away from my house. So. Okay, we made it. 32nd Street. We are gonna walk directly down until we hit into Penn Station. So on tomorrow's live stream, everybody, we're gonna do a deep dive into the ISM Services Manufacturing Index, the services PMIs that came out today. We're going to do an entire live stream dedicated to that. We are also going to be talking about the PMIs from the manufacturing sector that came out. We briefly touched on that. Oh wow, check this out. Hey, Bean B says, Tom, my brother-in-law, or cousin-in-law, works for the New York City Sanitation Department. Love that. Love that. So it's going to be a big stream tomorrow. A lot to cover, a lot to talk about. We're going to be talking about the PMIs, both in the manufacturing and the services sector of the economy. You know, this is a nice shot of the Empire too, with the TD Bank sign here. Azil says, hey Tom, you ever been a realtor selling houses for people in New York? So no, but I do have some news. So over the coming months here, I am going to have to get my real estate license in New York as well as Florida. So we may have some interesting content coming up, but the real reason why I need to get those real estate licenses is because later on in life, down the line, I want to get into some larger deals as it relates to real estate, like in the M&A type business. And I want to sort of have control over those deals. If I'm doing like a very, very large, hopefully one day, very large, like 300 unit to 500 unit multi-family deal, something like that. So yeah, that's what I'm going to do in my spare time. I am getting my New York State real estate license as well as Florida, but probably not going to do like sell residential stuff. I just mainly getting it to, build some connections in the industry. And as I build out my portfolio, I want to get into large M&A real estate. But no, I have not. Laytha says, Tom, I have a New York State real estate license, but it's been long expired. Denise, New York City says, join the Sirhan team. Yeah, I don't think I'd have time. I think I'll stick to software sales. We'll see. Yeah, Bagels and Walks, good to see you. So now we are at Herald Square, 34th Street. Outside of the original Macy's building. Sonia C says, Tom, whoa. Sonia C says, Tom, what was your first job ever? I think I was delivering pizzas. I think actually, I take that back. My first job ever, I was washing dishes. So I was a dishwasher. I was 14 years old. And when I was 14, I looked like I was 7 years old. But yeah, I would wash dishes on the weekends at like a diner. NMB 045 says, Tom, you're getting your license just for occasional deals, not doing it as a career. Yeah, so I think as I build out my portfolio of rental properties, I want to represent myself on the deals. You know, I've worked with fantastic realtors, right? Fantastic, very knowledgeable people. But I think I have a pretty good grasp on the market myself. So I think just based upon that, I think I could represent myself on deals. And mainly, real estate is a particular industry that I am interested in learning a lot more about. So I think as I build out my network in that specific sector, you know, maybe as my, hopefully over the next 50 years, oh, look at this, as my real estate portfolio grows over 50 years, you know, maybe I could roll that all into a larger deal. Let's say if it's, you know, 350 to 500 unit deal, something like that, and then get into, you know, big M&A real estate. I don't know. I think, you know, I sort of, the one thing I live by is when you're young, you might as well try everything and learn as much as you can. So the barrier to entry is pretty much like nothing. So I think it's just an easy way for me to learn about and do some market research while also being able to represent myself. So we'll see. Yeah, so I heard about that too. So Bed Bath & Beyond did announce like an interim CFO. It's absolutely horrible what happened. Yeah, stories like that are heartbreaking, to be honest. All right, 7th Avenue, everybody. We're making good timing. Mauricio's here from Brazil. Good to see you. Yeah, Leida, I was shocked when I heard the news. You know what I'll try to do, everybody? So the stream may start to buffer here, but I want to take you guys down into the Pennsylvania station because it's totally remodeled in there. That actually looks pretty good. I'm going to give New York State credit. They did a phenomenal job. But it may buffer when we go down there, but I think you guys are going to enjoy it. However, if we do buffer, thank you guys for joining the live stream. Feel free to leave a like on the video. And subscribe to the channel if you are new. And we'll see if we buffer as we go down here. But if we do cut out, we will be live tomorrow at 8:30 p.m. Eastern time. Probably from 57th Street. So hit the subscribe button if you're new. So we've been having some technical difficulties. Maybe I'm not shooting in 1080p, but I think I am. But check this out. You guys will see the ceilings in Penn Station used to be like 7-foot tall ceilings. Very, very low. But they've raised them. They're like 25-foot ceilings now. They're fantastic. Check it out. So after we make our way through all of the horrible ceiling stuff here, you'll see a huge difference. Check this out. So check it out, everybody. This is the brand new Penn Station. So this is the old Penn Station. This is in Moynihan. but they raised the ceiling. So if you see over here, that's how low the ceilings used to be. It used to be exactly this height, and now they raised it all the way up here. So I think they did a pretty good job. Daniel says, can we see what your face looks like? Yes. If you follow me on Twitter, @WalksWallStreet. So if you type in on Twitter, Walks Wall Street, follow us over there. You could see my facial features. But it looks pretty nice, I'm not gonna lie. And on that note, we'll end it. So everybody, thank you so much for joining tonight. We will be live tomorrow at 8:30 p.m. Please hit the subscribe button if you're new, and we will see you tomorrow. If you want to sign up for our free investing newsletter, please scan the QR code on your screen, punch in your email, and usually every other Tuesday after the market closes, you will receive a free investing newsletter covering the US equity markets, emerging markets, fixed income, and the like. So thank you for joining, everybody. I appreciate it. Have a fantastic night. GG NYC, Les S, Wendy England, Lay the, all of our moderators, everybody who is new to the channel, I appreciate it. Get some rest. Get ready to hit it hard tomorrow, Wednesday. I'll see you guys tomorrow. Take it easy. And to the mighty bull, have a good night wherever you are, because there is always a bull market somewhere, and you just need to know where to look. Take it easy, everybody, and we will meet again tomorrow, 8:30. I'll be expecting you. I'll be waiting. See you later.